Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about TPG RE Finance Trust Inc. Annual Report. TPG RE Finance Trust Inc. offers a diverse range of commercial real estate finance services. The company originates and acquires first mortgage loans secured by commercial properties, providing financing options for businesses and investors. In addition to direct origination, TPG RE Finance Trust also selectively acquires other commercial real estate-related debt instruments, including subordinate mortgage interests, mezzanine loans, and secured real estate securities. This allows the company to diversify its portfolio and provide a range of investment opportunities. The company's services also include note financing, preferred equity, and miscellaneous debt instruments, catering to various needs of commercial property owners and investors. As a qualified real estate investment trust, REIT, TPG RE Finance Trust is exempt from federal corporate income taxes if it distributes at least 90% of its taxable income to shareholders. Over the past year, TPG RE Finance Trust, Inc. TRTX, stock price has seen a notable increase of over 12.99%, surpassing the performance of the broader U.S. mortgage REITs industry. Several key news events and positive financial developments have contributed to this growth. One significant factor is the company's strong full-year 2025 results, which demonstrated its ability to generate income and maintain dividend payments. TPG RE Finance Trust reported robust GAAP net income and distributable earnings that comfortably covered common dividends for 2025. This performance has likely boosted investor confidence in the company's underlying business health. The company's strategic growth initiatives have also played a crucial role in driving stock price increases. In 2025, TRTX originated $1.9 billion in first mortgage loans, expanding its loan investment portfolio to $4.3 billion, with 100% of these loans performing well. Additionally, the company strategically increased its exposure to the multifamily and industrial real estate sectors, which can enhance investor confidence. Furthermore, TPG RE Finance Trust has maintained stable credit quality and diversified financing, limiting margin call risk. The company's regular dividend declarations have also been attractive to income-focused investors, contributing to stock price stability and appreciation. While fourth quarter 2025 earnings per share and revenue missed analyst estimates, the overall strong full-year performance and growth initiatives presented a positive outlook that likely supported the stock price increase experienced by TRTX over the last year. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline are multifaceted and influenced by various factors. On the growth side, origination activity, increase in loans held for investment, and rise in collateralized loan obligations contribute significantly to revenue expansion. Additionally, an increase in accrued interest and fees receivable, as well as revenue from real estate owned, also play a crucial role. On the other hand, revenue decline is primarily driven by a decrease in net interest income due to lower average index rates and credit spreads. Other revenue has also decreased, mainly due to a decline in cash held and interest earned on cash balances. Furthermore, an increase in credit loss expense has negatively impacted revenue growth. External factors such as changes in interest rates and macroeconomic conditions can also impact revenue growth or decline. The quality of loans, real estate value, operating cash flow, and the financial condition of borrowers and sponsors all play a significant role in determining revenue outcomes. The net income of the company experienced a decline between 2024 and 2025, with a decrease of $14,016. This downward trend continued into Q3 and Q4 of 2025, where net income decreased by $18.2 million and $11.3 million respectively. The significant drop in net income is also reflected in the profit margins, which declined from 13.2% to 12.3%. The reasons behind this decline are multifaceted. One major contributor was the company's increased risk-taking and speculative investments, which led to a concentration of investments in certain property types such as multifamily properties and office buildings. This strategy proved costly due to the illiquidity of loans and other investments, resulting in a higher risk of default on non-recourse loans. Additionally, environmental liabilities and remediation costs, natural disasters, lender liability claims, non-compliance with laws and regulations, ground lease terminations, and increased regulatory burden all contributed to the decline in net income and profit margins. These factors collectively led to a decrease in profitability, highlighting the need for the company to reassess its investment strategies and risk management practices. The company's interest expenses have experienced fluctuations over the years due to various factors. On one hand, accelerated amortization of deferred financing costs, higher interest rates imposed by the Federal Reserve, and potential margin calls under secured credit agreements have contributed to increased interest expenses. However, there are instances where interest expenses have decreased, such as in 2025 when it dropped by $12,394 or 6% from the previous year. Despite these fluctuations, a closer look at the company's overall trend reveals that interest expenses remain a significant concern. The impact of higher interest rates and potential margin calls on liquidity is particularly noteworthy. It is essential to consider these factors in conjunction with other financial metrics, such as debt-to-equity ratio and net interest income, to gain a comprehensive understanding of the company's financial health. The relationship between interest expenses and other financial metrics is crucial for making informed decisions about the company's future direction. By analyzing these connections, stakeholders can better understand how changes in interest rates or margin calls may affect the company's bottom line. The multifamily property segment has been a standout performer in the market, accounting for a significant share of loan investments. According to available data, multifamily properties made up approximately 53.4% and 53.9% of total loan investments. This indicates a strong demand for financing in this sector, suggesting that investors are confident in its potential for growth and returns. Management is optimistic about the company's outlook, citing its significant loan portfolio, with a total exposure of $4.29 billion as of December 31, 2025. The company has implemented various risk management strategies to minimize interest rate risk, including matching the duration of assets and liabilities. This approach demonstrates the company's commitment to prudent financial management. The report highlights the company's ability to create structural leverage through co-origination or non-recourse syndication of senior loans to third parties. This strategy allows the company to expand its loan portfolio while minimizing risk. Furthermore, the absence of non-consolidated senior interests as of December 31, 2025, suggests a strong financial position. Management's focus on financial performance is evident in the report's detailed overview of revenue recognition, allowance for credit losses, and financial ratios. These metrics provide valuable insights into the company's operational efficiency and risk management practices. Overall, the report presents a positive picture of the company's outlook, with a strong loan portfolio, effective risk management strategies, and a solid financial performance. The company has made several acquisitions and divestitures as part of its business strategy. In terms of acquisitions, the company has purchased various types of commercial mortgage loans and debt instruments, including floating-rate mortgage loans secured by commercial real estate assets. It has also acquired a pool of fixed-rate mortgage-related securities and commercial mortgage-backed securities, CMBS, and CRE CLO debt securities. Furthermore, the company has acquired ownership of properties securing loans through foreclosure or deed in lieu of foreclosure, and it continues to originate and selectively acquire additional assets. This expansion of its portfolio is aimed at increasing its presence in the commercial real estate market. On the other hand, the company has also made divestitures as part of its strategy to optimize its portfolio. In 2020, it sold CRE debt securities in March and April, and it continues to sell real estate-owned assets, REO, and liquidate underlying real estate. These divestitures are aimed at reducing the company's exposure to certain types of risk and improving its overall financial performance. The company has a history of paying dividends to its shareholders. This is evident from the extracted summaries, which point to specific pages that mention dividend payments. On page 50, it is mentioned that the company paid dividends, and this trend continues on subsequent pages such as 66, 69, 71, 92, and 96. However, when it comes to share buybacks, there is no explicit mention of the company engaging in this practice. Despite this, a payment of $25.3 million made in 2025, referenced on page 96, may be related to share buybacks, although its exact purpose is unclear. Concerns about inventory buildup and supply chain disruption are evident in various sections of the extracted summaries. On page 17, it is mentioned that global trade disruption, conflict, and trade tensions resulting from U.S. tariff implementation and retaliatory tariffs by other countries pose a risk to supply chains. Furthermore, on page 24, it is explicitly stated that global supply chain shortages or slowdowns can create challenges. This highlights the potential for disruptions in the supply chain, which could lead to inventory buildup if not managed properly. Additionally, on page 61, several factors are listed as contributing to supply chain challenges, including inflation, labor shortages, and tariffs on imports of certain products. These factors can all contribute to a slowdown or disruption in the supply chain, leading to concerns about inventory buildup and potential losses for businesses. That concludes the financial summary for TPG Refinance Trust Inc. Feel free to comment below, and I will be happy to answer them when possible.